Topic: Time value of money in fixed income and equity. From Learning Module, Time value of money in finance. Coupon rate 9.4% is lower than YTM 10.2%. Bond must trade below par $100. Option B $127.96 and option C $146.27 are impossible. They would require coupon higher than YTM. Always use remaining maturity 8 years, not original maturity 12 years. Semi-annual bonds require halving rates and doubling periods. Mortgage payments are monthly, so convert rate and term to monthly. Fully amortizing means no balloon payment at the end. Avoid forgetting to use 80%, not the full property price. She wants to know the value of her investment at her retirement, which is 12 years from today. Since the bonus invested starts at the end of year 1 and ends at the end of year 12, this is T equals 1. It is only 11 periods getting 4% annual return. The present value is T equals 0, which is the beginning of year 1. Different approaches give the understanding of time value of money. This is the same scenario with different question. The bonus starts at the beginning of year 1, T equals 0. Until she withdraws at her retirement, the end of year 12, it will be 12 periods. How much she needs when she retires, the $1,246,221 is the present value here. The future value is 20 years later at zero, after she has spent all annual $100,000 retirement income. On the second calculation, that present value $1,246,221 is actually the future value from today's point of view, because she is not retired yet. She is planning her future. The present value here is zero to start with. In time value of money function in financial calculator, PMT can be an installment, annuity, income, deposit, etc. Pay attention on timings where cash received. The term t equals 0 and t equals 1 is when 1 year has two periods. At the beginning, t equals 0, and at the end, t equals 1. If the question does not emphasize on the beginning and the end, always use the end of year calculation. In the annuity formula, it is ordinary annuity. The case here is the present value we want to know is of year 1, not year 0. Every cash inflow needs to be discounted back. If received at the beginning of the year, the discount year is 0. If received at the end of the year, it will be discounted at one full period. If the question doesn't mention any beginning or the end, always calculate as cash received at the end of the year. The timing here is immediately. It means cash flow at the beginning. Using TVM function on BA2+, don't forget to set on BGN mode. Using NPV function on BA2+, don't forget cash flow starts immediately. CF0 is 2000, not 0. Using annuity deal formula, there is an addition, 1 times discount rate. Differentiates from ordinary annuity. Using manual calculation, cash flow starts at the beginning, plus another 95 periods. Using financial calculator, BA2+, when borrower takes out a loan, its present value, not future value. On constant dividend growth model, always use next period's dividend, not the most recent dividend. First stage, get the present value of the cash flows. Second stage, get the present value of the cash flows if grows indefinitely at declining rate. Remember to use second growth rate on year 4 dividend to calculate terminal value. Don't forget to get the present value of the terminal value. Current intrinsic value is the present value. It equals present value of the cash flows and present value of terminal value. Topic: Implied return and growth. From Learning Module, Time Value of Money in Finance. Remember the formula, always ending, the future value, is divided by the beginning, the present value. The wordings can be anything: expected dividend, next year's dividend, D1, etc. Get used to the wordings as they can be very confusing. Always use next dividend, not current, in constant dividend growth model. Master how to use the financial calculator. Here, how to calculate using two approaches to get the understanding the timing of cash flows. When the cash flow is constant, use TVM function. Cash flow function on financial calculator is for both irregular and constant cash flows. Another annualized return exercise. When observed forward PE, the market, is higher than justified forward PE, the expected, the market is overvalued. Topic: Cash flow additivity. From Learning Module, Time Value of Money in Finance. The investment with a higher NPV is better because it adds more value today. Use cash flow function on financial calculator BA2+. Cash flow additivity requires discount each cash flow individually based on its timing. Then sum the present values. Cash flow additivity is basic principle in capital budgeting, bond pricing, merger analysis, and risk management.